Now we're going to talk about the goal and the value of an M&A model. What does M&A modeling actually help to illuminate? Well, perhaps the most important thing is an M&A model sort of shows you what the impact is on the financial statements when two companies are combined together. That's called accretion dilution or merger modeling. And at various deal assumptions, you can see how the impact on the financial statements might change. Looking at those things, you can also understand what the implications are to the company's value, both the buyer and the seller. But really predominantly when you're looking at a merger model, you're trying to understand what the implication is to the value of the buyer, the company that's going to sort of persist after the deal is done. How does it change that company's valuation, and how does it change its credit ratios, its ability to access capital, etc. Now, these conclusions, the things that we're gonna be able to look at once we build our model, will enable us to understand whether a deal is feasible. What is the pricing capacity of the acquirer to pay for a target? And just as importantly, what is the optimal form of consideration from an accounting standpoint, from a valuation standpoint? Is it cash? Is it stock? Is it some combination of the two? And of course, what are the accounting implications? What are the accounting implications to doing the deal? So we've been talking about, we just talked about the accretion dilution or the M&A model as an important part of the analysis. The core model that M&A professionals build when analyzing an acquisition is called the accretion dilution model. And basically, an acquisition is accretive when the combined pro forma EPS, the two companies' EPS together as a combined entity, is greater than the acquired standalone EPS for that same period. So it's sort of a question of what is happening to the EPS at a certain period if you combine the two companies as opposed to if you just look at the acquired standalone. And presumably the deal is accretive if the combined EPS is greater than the standalone, and that's obviously considered a positive thing from the perspective of the acquirer. So a simple example to illustrate is suppose that analysts expect Procter & Gamble's earnings per share to be $3.05 next year, but if they were to acquire Colgate, you run a model and it's determined that the pro forma EPS next year, the combined EPS next year, would instead be $3.10. The deal is then considered to be 5 cents accretive. Now, an acquisition is dilutive if the opposite takes place. Once you look at that deal and instead of say $3.10, you get $3, the deal is considered 5 cents dilutive and break even if there's no real impact. And so a big part of what we're going to do in this course is try to understand how you build a model to determine that. It's not as simple as it might at first seem. Why this is important? Some of you that have gone through our DCF course and our comps course are wondering, well, what difference does that really make? Valuation, whether a deal is worthwhile or not is really a function, an argument can be made of just whether the company that you're acquiring, you're getting a good value for it. Is the valuation, is what you're paying greater than the actual DCF derived or comps derived value? Well, that's only part of the picture when you're talking about acquisitions, especially when you're talking about acquisitions where the acquirer is public, because the impact on EPS has very important sort of optics implications. And so you see in a lot of press releases for public companies especially that are doing deals, and here's an example of one, where they tout the deal is accretive as opposed to being dilutive, which is considered a negative thing. We're going to spend a lot more time talking about that, but here you see GenProbe was acquired by Hologic, and the first line is the transaction delivers attractive economics with strong growth in margin profiles, and it's 20 cents accretive to the acquiring company's adjusted EPS in the first year after close. So this is something that becomes a very important part of marketing the transaction to investors to sort of convince them that the deal is attractive and hoping that the acquired share price does well after the deal announcement. So in terms of terms, we talked a little bit about how the model that we're about to get into sheds light on what are the optimal forms of consideration. Well, acquirers generally can pay for acquisitions in one of two ways, either by paying cash, and you sort of think about high-profile acquisitions like Apple, acquiring Beats, although they didn't specifically disclose terms of the transaction, but companies that are cash-rich like Google and Apple tend to pay cash for deals, whereas other companies can issue stock for deals. So you can basically acquire stock in exchange for target stock, and that's a way to acquire companies, or you can just pay companies, the target, in cash. And you can see that traditionally, historically, cash has represented the majority of deal volume by dollar amount. So 58% of deals in the first half of 2014 were cash deals. And then an additional 28% of deals were a combined cash and stock deal, and only 10% of deals were pure stock. And that's fairly consistent with what we've seen over the last decade. The decision about how you finance a deal carries significant legal, tax, and accounting implications. We're going to touch on a lot of those throughout this course.